We're just waiting for another panelist to join us. There we go, there's Matthew.
Right.
Hi, Matt. You all right?
Yeah, not too bad.
So
Yourself?
Yes, yeah, pretty good. We're actually switched on live. I think Nick's
okay.
probably on his way. We'll see how that goes.
No problem.
Confuse us by changing the time.
Yeah, we have changed. Yes, yeah. Unfortunately, I will, just so everybody knows, I think Karen and I don't know if any others are, we've been invited to a government consultation this afternoon, starting at 3 o'clock. So we've moved our payroll question time half an hour earlier than our usual spot. So that's probably got everyone a little confused. However, it's an important meeting to get to, and a number of us would have been joining that. Yeah. And yesterday we had a similar exercise with payrolling benefits in kind, and I think we can cover off some of that. Shall I do intros?
More questions than answers, to be honest, Simon. But it was interesting.
Yes, yeah. There's an element of you're heading for a cliff. You're going to fall off it, sort of thing, or there's a brick wall coming up. But yes, maybe we'll cover some elements of that today. Yeah. Ben, do you want me to go through aspects of this until we manage to pick up on Nick for the time being? But I'll cover it. So just so you're aware, the presentation does not provide definitive answers to individual queries, and in some places takes views on matters which are uncertain. It's not intended to be relied upon in any specific context or as a substitute for seeking advice, legal or otherwise, on a specific circumstance, as each case may be different. That's a standard disclaimer for us today, because we're going to talk in general terms to you about various matters. Your circumstance may be slightly different, and often we're talking about things that may not actually be law yet and subject to parliamentary change or parliamentary approval, but we'll talk in terms of the facts as we understand them, on the detail that you provide and the information we have to hand today, and things may change tomorrow. Should we go through introductions? So if we go on the next. So I'm Simon Parsons, Director of UK Compliance for SD Worx. I sit on a number of government panels. I've won a number of awards, as to most of the panelists here today. So I have the Master of Science in Payroll Management through the CIPP, which I'm a fellow of, and I chair the BCS Payroll Specialist Group and an organisation called IRENE, which deals with electronic exchange with government. And great to be with you. I'll do it on the list as it's shown in the panelists, so I'll go to Karen.
Good afternoon, everybody. Delighted to be here as always. I couldn't make the last one. I'm Karen Thompson. I'm partner and head of payroll services for Armstrong Watson, a firm of accountants with our head office here in Carlisle in Cumbria. It's good to be here. I'm a chartered member of the Institute, and like Simon, I have the Masters in the payroll management as well. Working to awards, but it always makes me shy and embarrassed. But yes, we're both involved in a lot of consultation forums along with Richard and Matthew as we go forward, and forgive the little dog appearing in the background. Just in economies, little dog, I might add. But no, good to be here. Thank you.
Okay, thank you. And Richard.
Yeah, good afternoon. Richard Jewell, Director of Education at the Payroll Centre. Many years in payroll doing, supporting and teaching, similar to the guys that way and that way. Member of many consultations, lots of groups, and between us and a good number of other people, we try and support the industry.
And lastly, Matthew.
Thank you very much. Yeah, I'm Matthew Akrig, Policy and Research Officer at the CIPP. So we represent the payroll profession. Our charter means we represent everyone, not just our members. And as with Karen, Simon and Richard, sit on a number of different government forums, trying to do that to the best of our abilities.
Okay. Well, thanks for those introductions. We'll see if Nick manages to be able to join us at some point. So today's discussion topics that we've come up with, but feel free to ask any question on any subject, preferably related to payroll, some aspects of HR that you wish in the question area. Ben, I'm going to say, can you look at questions at all for us and point us in that direction, or I can see if I can do that as we go along in the interim. But if you hint there's a question there, I can take a look. But let's see how we do. So start thinking of your questions. The topics of discussion we're talking about today are payrolling 2027. How was your tax year end, and how is your new tax year? We'll cover some of the things and challenges we're seeing that are raised. We're going to focus a little bit on the low pay commission consultation for 2026, and we thought we'd have some discussion along the role of artificial intelligence and data analytics, and potentially how that interfaces with payroll, and see where that goes. Hopefully, well, we'll see exactly what information we can share, because some of this is sort of inventing a future which we don't really necessarily understand, and possibly solving a problem that we don't actually have now, but we'll see where we go. So let's go into payrolling 2027. Let's see, Matthew, do you want to introduce us to an element of payrolling and what that means, and has the date changed?
Absolutely. So as many of you probably are aware, we've been discussing this sort of thing for probably around about 2 years now. We switched over from the P11D system, now being called the legacy P11D system. So it's been a long time coming. And we now know that the payrolling of benefits becoming mandatory is being pushed to 2027. So the last you might have heard of it, if you've not kept up in the last month or so, is that mandatory payroll will be coming in from April 2026. When we move over to mandatory payrolling of benefits, they would make the accommodation and loans voluntary. At the moment, they're unable to be payrolled at all. But this current state of things is now going to continue into 2027. Good news, if you want to call it good news, is that in a technical note, HMRC has given us a little bit of a roadmap as to how we're going to get there. In the past year or so, I think the information has been fairly sparse, and that's meant that we haven't really been able to plan as effectively as we might want to plan. Simon, as a representative of software developers, certainly been getting very antsy about the technical information that would be required to make the necessary changes. I'm sure Karen, as someone dealing with the sort of payroll bureau space, wanted a lot more information to be able to advise clients and to work out what sort of charging structures they may be able to have with the absence of P11Ds. So at the moment, a bit of a weird space. We've got a bit of stability in that we know what's going to be happening for the next year or so. Anyone who maybe took some advice to move before they were pushed may be feeling a little bit let down at the moment, because we're now having another year to sort of transition across to that. But we do have a little bit more of a plan now as to what might be happening when, and the final go live date being April 2027, which we've been assured is the firm date now, but only time will tell.
I think it's quite interesting. So we've been running quite a lot of working meetings recently. So we've probably seen in the last 2.5 weeks about 350 in the industry, and a very large percentage are carrying on with their plan. We're certainly seeing the largest proportion of those who were going to go this year gone, and there's still a very high ratio who are going to look at voluntarily moving over next year, possibly just because of the planning they put in place. I think, to sort of follow on from Matthew as well, some of the key areas that came out of the discussion document that sort of told us the changing date also brought in some quite specific I guess, change and challenge to what we were originally, I guess, expecting. I think firstly, you're still doing P11D, which is massive, you know, and for those in software, which Simon has the pleasure of being involved in, it must have been a head in hands moment to realize that the field content for this process is going to be enormous, because you are basically replicating the P11D, but doing it in RTI, where currently, obviously, it's quite limited with the voluntary option. And I think that brings other challenges as well. By only having the P11D items, so let's use medical, and this one's come up quite a lot. There will be a field for medical, a field for contribution, like it is on the P11D. But let's say you've got private medical and dental, and you want to be payroll granular, which is really what you're going to have to be. You're possibly going to have a level of separation on the payslip, which has then got to be reintegrated into a single return for the RTI. So I think there is certainly challenges there. I think the second aspect is the principle that, again, the deadline isn't changing. So even though the hope, and if you read it, the challenge and expectation is that payrollers will work to their best ability to have returned by the final FPS, there will still be the window till the 6th of July or 5th of July to further return. And I guess the issue there is, and it was very clear in the document, you will only return the taxable value rather than collect any tax, which means in that scenario, you're going to have multiple P800 returns for individuals where you haven't been able to claim it. And that obviously spreads on to people on maternity, people on long-term sick, and so on and so forth. So I think it was going to bring quite a series of challenges, and I guess also quite a level of communication that is going to be required for your staff. Sorry, that's my sermon over. But I think it's really key.
Well, thanks,
100%.
Richard. Karen, did you have any thoughts from on discussion so far?
I have a lot of thoughts. Matthew alluded to some of them. I think, don't get me wrong, I was not sure where I am at the minute, advocate of payrolling of benefits, but it was to be simplification. And I think this was raised up yesterday as well. You know, it doesn't feel like a simplified process. And I've got a number of, when I say concerns, it's a number of considerations that we're going to have to tease out and try and overcome. So obviously you'll be able to come up with the software and whatever else. But for me, if you imagine what I'd really hoped for in a software project is that if you take something like medical benefits, would be a classic one. You tend to find in P11D software, let's call it, that's linked to payroll, you would put in the date, but it would only calculate an amount on the year. Yeah, the tax year. And what I was really hoping for was payrolling of benefits to be payrolling of benefits, not mirror P11D. Because by mirroring the P11D, there is the potential, and I wouldn't blame software if they did this because of the costs involved, is that it will keep its mirrored P11D software as it does now for voluntary payrolling. So if I take the software I use, we do it by component. It does go on the payslip as it happens, but it does all go into one for the RTI field. So when you do that, but it tends not to be date driven. So it means you've got to treat certain things as a component rather than using, for example, the expense and bends module. I mean, that'll be specific to different software. And Simon, no doubt, will be singing the praises of let's hope they're going to be doing that. But so there's that I've got, because, and then when I start looking at it from a client perspective, so Richard, you've just said about voluntary payrolling. We actually don't have many clients voluntary payrolling because they have been, do we or don't we? Because of course, don't forget, voluntary payrolling is going to be very different to the mandatory payrolling. So we've got, and don't forget, there's also going to be the big bang. So far, there doesn't appear to be any indication that we will, for example, during the 26-27 tax year, have a spec, because of course software, if it's the specification isn't due out till December, and I'll leave Simon to go on to that one, then there's no way we could potentially have like our payrolling of benefits in the 26-27 tax year that looked like what it was going to be for mandation, if that makes sense. It might not, because why would a software product do that when it's going to have to do a thing? So what that means is if anybody's looking to voluntarily payroll, they have to still register pre-6th of April. That will still apply. But if you do voluntary, your process is going to have to change. Now, if you use a service provider, at the moment, I don't know what, again, I'm still in this, what is that going to look like? I know the fields that are likely to be captured, so we can start to help clients and what have you that say, you're going to have to think about where you might get the data from in a timely manner to meet your payroll deadlines. But other than that, I don't know what my software is going to do yet, because there is no spec for the software yet. So we're still in this sort of catch-22, but then we've got the clients that say, well, is it worth me doing voluntary payrolling? Because do that. So if you then think about the big bang approach come 2027, if I just, without going into the numbers of clients, but if I think about the numbers of clients for which our firm produces P11Ds for example, that then correlates to those who have payroll with us, because obviously being an accountancy firm, they don't necessarily have payroll, they could have the services. It's quite a significant number. So where does my resource come in to put these all on in month 1? Because it's unlikely I'm going to be able to do it in months. You've got to, your way software works. You go into the new tax year. Likewise, if a holo do voluntary payrolling and they do say, do you know what, we're going to jump, we don't want to do P11D and do that, say from register pre-April 26, that's still a big bang approach. But then come 27, the whole thing will have to change. So all those who are voluntary payrolling will still have to provide information in a different way and whatever else. So these things, never mind the fact that do you really want to voluntarily payroll accommodation and loans when the legislation is still the same as it is now? And let's face it, nothing seems to have changed. Even though there is some really good suggestions. In fact, Sam from CIPSA had some good suggestions on how that might work. So that's where I'm sort of sitting, is it doesn't feel like a simplification, which it was always meant to be. And at the moment, it's great to know that we're going to have fields, and then I'll leave Simon to talk on the Class 1A bit, as to how that, particularly from a software's perspective. So at the moment, we've got a bit more information, which is good, but I'm not sure it gives us enough to really know what we're going to need to do going forward. That's my views.
Well, I think you're right. I think it creates completely different communication if you voluntarily move to the communication you've then got to give them when we mandatorily move. So is that going to make it even more complicated than it needs to be?
Well, and I think the Annex A is more complicated than the P11D, because it asks for more data than the P11D currently asks for. And that was one of the points I think I was making yesterday. Unfortunately, we tended to have some accountancy reps at the meeting as well who want it very granular. They seem to want it granular for tax returns, which was confusing because payroll benefits don't go on a tax return. They're excluded. P11D items go on a tax return because payroll items are already reported, so they don't need to be there. So that was one aspect, but the other is when you look at, and for anybody who wants to know what we're talking about, the document that was issued on the 30th of April by HMRC on the mandation, now being April 2027, has an annex to it, and it's called Annex Additional BICS Fields Likely to be Required on the FPS Return. And it gives some detail, but it adds more detail because, for example, the first is cars, cost market value, cash equivalent, Class 1A. Currently, Class 1A is a combination of all the benefit values and applied at 15%. And it seems to be they've then got precious metals, so those are into gold, I guess, platinum, cost market value, cash equivalent, Class 1A, property, Class 1A, other, Class 1A. So it seems like the Class 1A has become a granular calculation, whereas it isn't. And it's subject to rounding rules. So what is? And equally, the Class 1A is calculated at employer level, where these are all at employee level and individual items within employee. So the rounding is going to be a nightmare. and it's a sort of a challenge of thinking why. Plus, we already have a Class 1A field on the FPS already. Why don't we just shove it all in there? And that's an element of where I go. And Karen's probably witnessed that a little bit, and you get two sides. I was part of the committee of the Office of Tax Simplification, which proposed payrolling on a voluntary basis, which was brought in April 2016, and an advocate for it. It seems complicated. I guess the challenge is we have to change from moving to getting data up front early. That's fine, because you've got a single item on a pay slip which says MedBen or whatever, 25 quid, and that's tax. That's fine. But now they're wanting more information. So that means where is the administration of these benefits occurring? Is that moving into the payroll operations? So some of this sound a bit scary at the moment, and I'm sure it's to be finessed and discussed in its design phase, and it's only an indication, it's not what the final, but we're then moving into this world of granular information. The fear, I guess, is on inspection, because they're saying they want the extra information so that the inspectors don't have to come looking for it. And so my fear, and I welcome other views here, is what do they think they're getting in April and May and June? And are they going to pay close attention to it? Because I suspect that we're all guessing for the first few months, and actually a lot of the solid data isn't known until March. And in reality, so if these inspectors are really wanting all this granular data 12 times or 52 times a year, are they going to really start picking it and saying, well, come on, looks like you got the medical benefit wrong in May when it's correct in June? And so they're just some of the sort of fear factors I've got. But should people payroll for April 26? I'd say yes, it's a good running year, and it prepares you, and a lot of the process will have already been done. So at least half the job will be there. But there is an element of thinking your external benefit suppliers are going to have to present to us so much data they currently don't. And even, I've got to say, for P11D deadlines are usually quite tardy with it, that it's going to be interested on how it works. But Nick, welcome on board. You kind of joined us a little bit away, and yeah, we've just been discussing payrolling benefits in kind on our first.
I knew it was coming up. Welcome. Sorry for joining late. I got an unexpected call from my daughter's school, who's in the middle of a GCSE exam, so I had an initial panic. Fortunately, nothing to be panicking about, but I didn't know at the time, so I had to take it. So apologies, I'm a little bit late. I'm assuming we've gone through the disclaimers and everything else, so we're good to go. So we've actually had some questions in as well, so maybe we can jump into
celebrating, Nick. Sorry.
Yeah, you can always intro yourself.
I am celebrating after yesterday's epic Tottenham win. For those that follow me on Instagram, you'll see my son burst into tears when we finally won a trophy after 41 years of winning nothing. I'm sure many people on this webinar are not interested in football, but if you are, yeah, it was a late celebration for those of us Spurs fans. But we've had some questions come in, so I've picked up. I'm aware of what we're talking about today, so let me jump into some of those just to make sure nothing's been missed. And if you've already covered this, my apologies. The first one is, did the delay in mandatory BICS surprise the panel?
We're all going to shake our heads, because I think a lot of us on this panel have some discussions with HMRC. They come to us with different things that they want to talk to us about. And even though they never explicitly said it to us, there was always the undertone of, oh, we're not sure when we're going to get all this information together. With what we were just talking about, the BIC fields, we had conversations about sort of what they would basically needing to look at the system architecture in the background, see what they needed, because they don't want to regress the quality of data that they have from the P11Ds. But the worst case scenario was always be that we were going to get RTI fields for absolutely everything that was on the P11DB, and it kind of looks like that's what they're angling towards. But because of that, they were having sort of a little bit of confusion in the background as to sort of how they were going to broach this, and it always just seemed to me that it was going to get pushed back at some point. And obviously now we've had that announcement.
Although they did say it was time, it's time for us to plan. which I think was very good of them. Thank you.
I was going to add a real positive. I sit on the Admin Burdens Advisory Board, you know, which looks after sort of smaller end businesses. And James Ray, the XST, I think whether or not we'll get all the results we ever want going forward, he does seem to be a minister that listens. So, and quite pragmatic in his approach. So I think, as Matthew's just said, when highlighting to any minister, especially when they're new to the role, and you've got a whole load of professional bodies, employers, software developers saying, you haven't even told us what you want, but you want it by 2026, I think it was going to be a no-brainer that it was going to have to be delayed. So I'm very pleased it has been, because as Richard just said, it does give us time now to plan to a degree.
So on that one, Nick, I think we probably suspected it, and even if we knew or not, we weren't allowed to say anything until the 30th of April.
Okay, well, a follow-up question to this from another attendee says, do you think there's any chance of further delays, perhaps back to 2028?
No.
No. Lots of shaking of heads again. Excellent. Okay.
No. However, 27 may be what they call a soft landing year. So I think there'll be an element of allowance, and they've already announced in the announcement, I believe, that the penalty position is relaxed for 27. So you won't necessarily face strict application in 27, but it does hint that that will apply from 28. So it's a year to transition in under the new regime. However, we don't actually really know what the new regime is yet. But equally, I think there was an element of they had to come to realise that actually if software is to put this in, you do need to talk to them at some point. And it got to a point where the timeline for that they're indicating for April 26 would be it was too late. So April 27 has more of a sense to that timeline. What I hope it doesn't mean though, Nick, is they decide that they can now wait a year before talking, because they can't. They need to start next month.
Yeah, I think they did state that they are talking about the payrolling benefits penalties will be introduced rather than replicating the P11B penalties. So
yeah, I think there was something that said originally when it was to go live from 26 that for the first year there wouldn't be any penalties for unintentional non-compliance. However, there still would be the normal late payment penalties, etc., associated. So while they'll give people a year to sort of get used to it, and if there's any small errors that result in underpayments, they might let you get away with that, provided that you pay back the underpayment, but there'll be no penalty on top of that, but you would still have late payment fees.
Okay, well, let's go to our first poll and get the audience involved. I've got a couple of more questions I'm going to ask while we wait for those poll results to come in. So we'll kill two birds with one stone here. The first poll is for PPIX. Are you acting now? Or are you going for 2026? Are you waiting for 2027? Or not applicable for you? So 4 options here: acting now, going for 2026, waiting for 27, or not applicable to you. While we're getting the audience to vote on that poll, there's 2 other questions that have come in. The first is this: what should clients expect their software providers to do? If some employers are already onboarding, why hasn't software caught up? Perhaps I'll come to you with that one, Simon, because I know you're part of the various payroll software committees. Maybe you'd be the best one to answer.
Well, I think it depends what software you're talking about, and also understanding what that software market is for the supplier. So some software are what used to be desktop or cloud, that for SME solutions, and they may be fairly basic. And then you've got other suppliers who'll be more extensive. But this all takes design and effort, resources, programming, etc. But if we're talking about payrolling as it was for April 2016 when introduced, then I think you probably find that most of the main suppliers were ready. And certainly, if we talk about Worx, that's a bit of self-advertising, I guess, for the sponsor of the event today. They've been payrolling probably for 30 years. So even before formal voluntary payrolling came in with Payroll. So it's ready now. However, in relation to why aren't they ready for April 27, or the HMRC actually haven't defined what they're after at all, so they
Sure.
can't be.
And we have a little bit of time there as well. So next question, do we know if anyone has raised this, that it's already payrolling their BICs? Does that make sense? Do we know if anyone has raised this, that it's already payrolling their BICs? Does that make sense to you, or are we missing some part of that question?
I think we might be missing a
raised
part.
what?
Yeah,
I
that
think
was
it
my
might be in
question.
relation to something we were talking about earlier. But
It could be. Yvonne, if you can just
Yeah.
clarify that for me in the question box, that'd be really helpful, and I'll re-ask
Sure.
the question. While we're doing that, let's get some of these poll results then. So we've got 29% are saying they're acting now, 22% going for 2026, 40% waiting for 2027, 10% not applicable. Richard, perhaps you can give us some commentary on these poll results.
Yeah, it's quite interesting. I guess acting now would be fairly high anyway, because people would have already committed prior to changing dates to payrolling to prepare for 2026. So I suspect that one was always going to be higher than going forward in 2026, because now there is that further year. And as Simon quite rightly said, there is now a level of, I guess, lack of knowledge as to what it's finally going to look like. And yeah, the waiting for 2027, well, you've got to look at an industry process that is managed in so many different ways that people aren't going to move away. For instance, accounting firms and bureaus alike will stay with the model they have for as long as they can,
Sure.
if for no other reason, fiscally and process separation. So no, I think it'd be about right. Sounds about right to me.
I've had an observation coming from an attendee as well. It says we're already payrolling via Iris and it's working really well. So that probably links into that acting now piece and people already working through. Well, look, we've got our next topic, which is going to be how was tax year end and the new year, which I think is interesting because for some, we haven't finished yet. We've got some deadlines coming up on the 31st of May, which I suspect is why Simon's got a dry smile. Maybe I'll come to you, Karen. Welcome, good to see you again. Let us run us through the tax year, things we need to consider, because of course it's not over for everybody yet.
Well, I'll come at it from an agent's perspective rather than employers, because obviously year end is nowhere near as bad as it used to be with the P35, P14 days. So that's the first thing. However, it comes with its own set in the fact that this year, national minimum wage, the fact that it was, so you've got to the end of the year, so the P60s, obviously they'll all be running, and that depends on the size of you and what you're doing. But it was really about implementing new national minimum wage rates en masse. As a consequence of that, which we've talked about before, it's then the pensions issues, was particularly with salary sacrifice, of where people had to be taken out of them. That increased significantly. Then, of course, you had the employment allowance. So this was where, particularly from an agent, where you're having to ask your clients who now may be eligible because they no longer have the 100,000 threshold, but that doesn't mean that they don't get public funding in some way, or that they don't have a connected company that you weren't doing. So for us, whilst you'd have thought, yeah, okay, it's good, and other agents, it was actually the start of the tax year that caused the biggest piece of work in month one, and particularly week ones. So yeah, that's where it was. Student loans, well, you're always relying on people to tell you what the plan is. So thankfully, we've got software that actually just gets all that from HMRC on the whole. But yeah, so overall, the team survived, is what I'll say. We celebrated at the end, and this month feels much more calm compared to last month.
Well, that's good to hear. Well, there is a little bit of calmness, and we'll come back to this in just a moment, but I want to just revert back to the question that came in from Yvonne, because I've got some clarification here. So back to the panel on this, just slightly reverting back to PBICs. I just wondered if anyone currently payrolling their BICs had raised concerns about the process that the panel members are aware of. For example, is it better? Is it worse? Is it more resource heavy, generating more inquiries, etc.?
As a general principle, I've tended to find it is less because I think it becomes ingrained. The problem with P11Ds is when I was having my benefits processed through P11D, as we would in SD Worx, I'd have to place that on annual returns. I'd have to consider other factors. Absolutely hated the fact that they'd collect 2 years in one. after the first year of a new benefit and code in debts which seem to go on forever. So I was always happy, and I've got to say, when I do my self-assessment, I always pay the bill on 31st of January. I don't want my tax code touched, sort of thing, because I think that all sorts of plays tricks, and it's good to have your steady income, as it were, planned out. So the Zamtiv, I actually think it works well. I'm personally speaking there. There are some challenges with it, Nick, for some users, because it is different, because payrolling looks to the future of what's going to happen, whereas P11D is always reflecting on the past. So there are those aspects, but I don't even think about it these days. Does that make sense? So I don't have to put it on my return. So
that links to a comment that's come in, to be fair. Someone's commented to say, Andrew's commented to say, it's more work each month, but much less work at the end of the tax year. Overall, less work, in my opinion, if you have a good system of tracking new, changed, deleted pics. I think you see some nods here.
I think that's what I was maybe going to jump in and say, is that it depends on what your sort of data flows look like. It can be very different in-house versus a sort of software, payroll service provision like Karen would do, because you need access to the right data. And as Simon mentioned earlier, the data that you get from these benefits providers can be different depending on the benefits provider. If you add an extra link into that chain where the employer has to give that to the payroll provider, it just becomes a little bit more complex. So I think sometimes it can be a little bit simpler for an in-house payroll. Not always, but it can be, and that's an important thing to consider as well.
I was going to say from an agent. Oh, sorry, Richard.
I was going to say the other key for me is, you're going to reduce and hopefully to a level remove those retrospective queries. The number of people who have no comprehension of how their tax code works, who will get a P800 or equivalent, who then will contact you. And obviously, if it's being payrolled in real time, a lot of that's going to be removed. So I think there is certainly massive gains on customer position. Sorry, Karen.
I would agree with that. As a person myself who has payrolled, I much prefer my tax code being left alone. But just be mindful as well, don't forget the P60 does show that. So for anybody who is earning over 100,000, that will impact your tax code because you'll go into the net adjusted income. So it does impact that. So where the bit where you start to lose your personal allowance. But I was going to say as well, from an agent's perspective, and obviously Simon's a bureau as well, but for accountancy, I'm in a slightly different position because our tax team do the P11Ds rather than payroll. So this will be, or we do it now, but it will be a change because in order to be able to do this with ease, we will have to generate some form of import. So clients will complete X to tell us what's going on. And again, it's about thinking about where that data's coming on. For those that we do payrolling of benefits for now, albeit it looks different in as far as the fields go to RTI, actually we are getting the information by component level because clients who have it want it detailed on the payslip. So as far as our input sheets go for cars and everything else, that's unlikely to change. The challenge will be getting clients, asking clients to do that, not send us their medical list of here's all the employees who get the benefit, off you go. So there will be some changes, I would imagine, for a lot of agents as to how we get the data in order for it to be streamlined, be efficient for both parties. But for individuals, without a doubt, certainly after 12 months, the queries will drop. And it is, I do think it's better that it's just taxed at source and you don't have that worry at the end of the year. And the also advantage is HMRC will also adjust for that net adjusted income because it already knows about that as well. So again, you end up not owing tax. For those people who don't mind owing tax, that's possibly a disadvantage for you. But I'm one of these that would rather pay more than less and be in credit.
Yeah, I can see Simon nodding to that as well. I'll come back to you, Matthew, then. So we're going to bring it back to tax year end. There are some problems with student loans, some new year changes. I wonder if you can just make those points clear for the audience. And while Matthew's going through that, if you have any questions over tax year end or any questions regarding the international employment filing deadlines, which are coming up on the 31st of May, put them in the questions box and I'll give those questions to our panel shortly. Matthew, over to you.
Fantastic. To be fair, I'm not entirely sure what new changes there are with the student loans. As Karen said, always with student loans, make sure you're getting people on the correct plans. But there are some new terms and conditions for the 25 to 26 tax year that are on the Student Loans Company gov.uk page. Simon, was there any particular sort of problem we were angling for here?
Yeah, there are a few challenges coming up. The student loan company seems to be telling employers, one of them that I've seen is dated the 28th of March, that the employee that they have doesn't have a student loan and they're to give them their money back. So they're attempting to do that in April. The problem is you can't. So because you can't have negative student loan in the new tax year, it will not be allowed. HMRC will reject the submission. So it's one of the things I'm going to probably mention at the Student Loan Forum is why you're issuing give the money back notices to any employer in March at all, I'd actually say. It's other months. But there is an element of if you've gone into a new year and they've ticked the student loan starter box or declaration on the new starter in error, can you give it back in the new year? Well, actually, you can't, because your FPS would reject if you did it, for not just for the individual, for everybody. It would reject. They won't allow it.
Solution, Simon, what would you do in that instance?
Well, officially, the student loan company are meant to deal with it. Or the worst, and it's a bit of a nightmare scenario, is you have to go back and file the FPS for that individual for the prior tax year to show it wasn't deducted. Then you could potentially give it back, but you can't do it in the new year period. The FPS has no ability for it. I'll mention a name. Some people will recognise it, lots of people won't. It's called Brian Charmley, who was part of the RTI task force, who pled for years to allow negative values for lots of these fields to do away with the curse of the earlier year update, which of course disappeared in 2020, but now we have an FPS year to date. But even still, why do I have to travel back in time in my TARDIS and file FPS periods for a pay period that's closed? I just want to correct it now. So, but I think that's sort of the lobbying side on some of these consultation groups. And as an aside there, been very successful with the student loan company and the student loan consultation group, to the extent that we were lobbying on why they keep on sending generic notices to employers, telling them they should or shouldn't have taken loans, when there are two instructions that tell you that, called an SL1 and an SL2. So why are you sending a note to someone via electronic exchange, which may actually be read by a machine, saying you should be doing something when the machine doesn't know what on earth they're talking about? Issue the instruction. And they've actually started doing that. So there are other areas. Another area on student loan challenges, and I think it's still a problem on the tax return, is the tax return doesn't understand what's earnings for student loan deductions. And it's class 1 earnings, which are not returned on the tax return. And we had that challenge with the student loan company issuing messages to employers saying, you haven't taken a student loan and we can see that your taxable gross is over a certain value. It isn't judged on taxable gross. It's judged on class 1. And but they've actually changed that.
Another field for the new returns, though, haven't they?
They have.
The self-assessment for class 1A.
They have, yes. Yes, so they've improved it because they've recognised the problem, because the self-assessment would then assess them on values which weren't subject to student loan at all. But that's one aspect of the new change. The other, if I link into it, Nick, if I may, is that we've had lots of people inquiring on the March pay paid in April being NI'd at the 15%. Yeah, point of payment is when it's assessed. And equally, they're then saying, but we had a late starter. So the late starter missed the March cutoff, and we paid them in April. Surely their March late payment should be at 13.8. Unfortunately, CWG rules, I think it's about 3.1.5, tell you you pay it at the rate applicable at the point you paid it, and the bandings as well. So they're saying, but surely the at LEL value is wrong for that period. It shouldn't be £125. It should be 123. Sorry, it should be 125.
We had a similar situation, Simon, but this one actually, their month 12 was February. Well,
Right.
as in when they worked,
Ow.
not when they paid.
Sure. Oh,
and
yes.
It was like
yeah.
they said, well, can we not now make their payday was the 6th of the month? And I said, well, no, you've run month 12. What have you done every other year? You could only, your months. It wasn't a client, by the way, if I was, it was a query that came through. And I was like, well, no, if that's your payday is the 6th, you've run it month 12. Therefore, month 1 is 15%. But they were trying to sort of say, well, can we do something? It shows the impact that that's had, though, on people who are trying to find a way of not paying that as much as they can.
Yeah.
Well, it has had an impact. I got a very sad email here in Devon for a small restaurant down the road that's just closed, and they blamed it very much on the NIC increases and staff costs, and they're doing events only. And this is a personal thing because it was one of our favourites in the local area. But sometimes it's those smaller companies you don't see that get hit by these impacts, and they directly referenced it. It's Winslade Manor, which is just up the road from here. So that was a bit of a shame. But back to student loans, I've got a question here, which is worth asking while we're in that student loan zone. Can you explain how you deal with an employee who with 2 student loans, for example, Plan 1 and Plan 4?
Yes, sure. And actually, SD Worx have got a little resource in. If you went to something called payhr.uk, which is the SD Worx Knowledge Centre, and looked at the student loans, I've got to say it's a bit internalish if you're not an SD Worx user, but it has a table in there which tells you the rules on multi. But if you're declared as a Plan 1 and a Plan 4, Plan 1 is supreme. All right, and there's a pecking order, and the pecking order is Plan 1 is top, then it's followed by Plan 4, because Plan 4 is the equivalent of Plan 1 for Scotland, and Plan 2 is back of the queue, if that makes sense. So if you've got multiples, Plan 1 is always top, Plan 4 is next, Plan 2 is last. And student loans, so postgraduate loans can be applied at the same time of any of those. You can't actually deduct more than one because there is only one student loan. They just have different plans and they flop from one to the next. Does that make sense? So once Plan 1 is paid off, it'll go to Plan 2 or 4. Whatever.
You'll probably find your software will do that as long as you've put in the correct dates in the plans.
Correct.
Most software will, just like court orders, it will put them in the right order and take what it's due.
Yeah, and the other oddity about these, Nick, is the HMRC do not issue a stop notice for any plan type. All right, so if they issue a stop notice, it stops all plans.
Interesting.
So you get a start instruction or a stop instruction. The start instruction might tell you the type, but the stop notice is for all. So it's odd because there is actually only one student loan deduction, but it has types that are operated within it.
I see. That's really helpful. Richard, I know you go up and down the country supporting clients with tax year end and trading and things like that. Anything else you'd like to add before we move on to our next section?
I guess it goes back to probably the start of this section, but also importantly back to our last one of these. The thing we are spending more time talking about than anything else is salary sacrifice, as Matthew said at the start. So many people who are being now impacted to the point that sacrifices are too high for national minimum wage. And the first statement from 60–70% of people is we'll just move it to net. And if you remember a month ago, Simon was quite clear on this, and I probably only said it about 17,342 times in the last 2 weeks, that it is still a benefit to the employer, and therefore moving to net does not remove the problem. The options are you remove the sacrifice or you re-agree longer terms to reduce the value. But it is a real problem because it is it's a mental fault, isn't it? Well, by moving it to net, it's no longer a sacrifice problem. Well, it isn't a sacrifice problem, but it's still a national minimum wage one. And I think that must be very, very clear to people, because it would also move it actually to a naming and shaming problem where a sacrifice error won't. So you're actually creating more problems for yourself in so many beautiful ways.
Yeah, and it may be just worthwhile reiterating that. So if you're giving a benefit via salary sacrifice and you change it to a deduction, it still reduces national minimum wage because they're buying a benefit off the employer, and it's captured by section 10 of the regulations, or regulation 10 of national minimum wage regulations, as a deduction which also reduces minimum wage, and that's a protection to stop employers exploiting employees. So the only options are end the arrangement, or as Richard suggests, and the term HMRC uses, cap it. So you cap it at the maximum you can reduce it, because again, just reiterating what Richard said, a deduction which takes you to below minimum wage is a breach of national minimum wage, which will get you named. A salary sacrifice which reduces you below national minimum wage will get you with the obligation to pay the top up, but it's not a naming offence, so you won't be named for salary sacrifice breach.
Does it also include net pay pension, Simon?
Net pay pension, well, it depends what you mean. A net pay arrangement pension is one that's deducted before tax. Pension contributions from an employee, even though it's to an employer scheme, are forgiven. So pension contributions are allowed, as are share incentive plan or equity purchase. So equity purchase, even if it's within the employer, are allowed because it's allowed by the regulation. But paying for a bike isn't.
Yeah.
Right. So
I think the other key, Nick, as well, is the phraseology is really, really important here. A pension deduction from the employee is a pension deduction from the employee. An employee sacrificing in return for a benefit is not a deduction.
Yes, it's not an employee contribution at all. They're contributing zero. So they've taken a pay cut. So salary sacrifice pensions, whether it's net pay arrangement or relief at source, is a risk for national minimum wage.
Okay, good. And anything from your side you want to add, Cam, before we move to the next section from the client side? Have we covered?
I think the only thing that was probably, we've all got our appendix 4 and 8 deadlines next week. It's just a reminder. So you've got any short-term business visitors to get in. Sorry, Karen. I'll let you, Karen.
Okay, that's great. Well, let's go over then to the Low Pay Commission Consultation. Obviously, the Low Pay Commission is conducting a consultation for their recommendations to the government on national minimum wage rates from April 2026. Matthew, I'll come back to you. I know you're very heavily involved with CIPP in various consultations. Perhaps you can give us a bit of an overview.
Yeah, fantastic. So as with every year, the Low Pay Commission wants feedback on the national minimum wage and national living wage rates. As usual, they want to know what the impacts were of the last round of increases, what impact it's had on employment prospects, particularly for those younger age bands where the rates are lower. And they're doing the same thing this year. They're asking all those usual questions. And, you know, we could talk about salary sacrifice again at the bottom there, but I think we've just covered that. But the key thing that they're asking this year is opinions on the removal of that 18 to 20-year-old age band. And they've given a couple of different options with the hope of getting a little bit of feedback on what would be the best option and what would have the best outcomes. So to try and really simplify it down, there's two options. We can either raise that 18 to 20-year-old band up higher until it reaches parity with the national living wage, at which point they'll get rid of that 18 to 20-year-old age band, or we could raise each year in that 18 to 20 age band by a significant amount to meet the national living wage, and over the course of a number of years achieve parity for each of those ages. So for example, in 26 we would raise 20-year-olds to the national living wage, and then we'd have an 18 to 19-year-old age band. Then in 27 we could raise the 19-year-old to the same as national living wage, and so on until we have 18 and plus is all at national living wage. So there's a couple of different options there. I do recommend, if you are interested in that, go have a quick look at the consultation. There's some really helpful graphs to illustrate those different options. Personally, I'm not sure that there's a sort of standout winner in terms of which one would be best. I think if we start messing around with that 18 to 20 age band by putting each year up individually, there are going to be more opportunities for non-compliance in terms of people not switching over to the correct rates at the right time. So there maybe is a little bit of a business comprehension thing that would need to happen if that option was gone with. Maybe it's best to avoid that completely by going with the other options. So I think there are pros and cons. I don't think either's right or wrong, but the CIPP are going to be doing a think tank. So if you are a full fellow or chartered member, keep an eye out for an invitation to that. So we want to get people's feedback, what you want to do. And I think we've got a survey live at the moment. If you just want to give us your quick thoughts on our Survey Monkey survey, just go have a look at our news pages, because we want to represent what's best for you guys. So if you have a clear way in which you want to go, that's what we want to recommend to the Low Pay Commission. So go and have a look at that. But I'll sort of hand over to the other panelists if they have any sort of thoughts on those options.
Yeah, happy to jump in if you want to.
I think that's the professional phrase for it. Doing it year for year for year. So I think you're quite right, Matthew. I think it will create huge compliance issues for many.
Yeah. But they've also indicated the sort of range they're looking at, aren't they? I don't think they've been given their remit yet, so they're basing it on older remit. So I guess the government have got to set the remit on what it is, but they're looking at the affordability of a new rate falling between £12.50 and £12.80 for the national living wage level. But as Matthew's saying, there's that sort of two options. It's do we step up the whole band until it reaches it in a number of phases, or do we do it year by year? On their year by year model, that means that the 20-year-olds will be in at 26, 19s at 27, and the 18-year-olds will be at national living wage levels by 28. It's interesting that on their graph they kind of show indicative values. So they're kind of showing a 12.56 rate for 26. I say that's within that 12.50 to 12.80 range. Then they're going to 12.82 indicative. And then it reaches 13.09 and 13.44. So it's sort of everybody's aligned when it gets to that 13.09. But they're just predicted on a basis of current thinking of mean average earnings and things like that.
It is predicted, but to sort of go into those graphs, it would mean that in 26, those 20-year-olds would essentially, if they were on national living minimum wage, get a 26% pay rise, which is phenomenal for them.
Add on 15%.
Yes.
It obviously could create some forecasting abnormalities, shall we say, where if you have different aged workforces, it's going to mean vastly different things to you as to which of these options is better.
But I think this is where the Low Pay Commission consultation is great, because if we're feeling that's unreal as an employer or too much of a burden, and we're operating a favourite restaurant place down in Cornwall or whatever, they're asking for that. So they're asking for information and data on affordability, what impacts there have been this year with the rises, and what's the prediction on young worker implications. So I think they are looking for people to actually declare if we feel there is going to be impact. I think historically they've tended to find people have said that national living wage, national minimum wage would impact employment in the UK, and it hasn't been seen as impacting at all. It's been seen positively. However, we've not had the rises we've had for the past 3 years before, and they're significant. So if you added up all the rises over these past 3 years, that is a significant cost. Of course, they've all got that income to spend on buying goods and services and things. So potentially we've got more income coming in revenue. But yeah, it's worthwhile getting involved because you've got those sorts of transitions. They're also looking at the apprenticeship angle as well. So I think they're after information on apprenticeships because the apprenticeship rate also raised greatly, and they're asking questions like, how do you come up with your apprenticeship rates and why? Because I think, is there some proposal, I'm saying this from memory, I think there's some proposal of the apprenticeship being a percentage of the age-related rate. Did I see that?
I'm not 100% sure about that, Simon, but I know that the apprenticeship rate is now aligned with that 16 to 17-year-old rate. So it looks as though they want to do a similar thing with the apprenticeship rate that they're doing with the national living wage, is to get rid of those extra bands that have the potential to cause areas of non-intentional non-compliance. You know, anywhere where we can simplify this is going to be a good thing in total for the compliance aspect. So I wouldn't be surprised if there was some talk of getting rid of that apprenticeship rate, because the apprenticeship rate, again, is one of those things that causes so many problems, as salary sacrifice does, in when to apply it, when to not apply it. You know, we've seen, I'm sure Richard will have seen in many situations, people applying the rate when they shouldn't do. You know, if you employ someone to be apprentice, but they haven't started their apprenticeship yet, are they an apprentice or are they not? And people start applying the apprenticeship rate when they shouldn't do. It's something that if you can get rid of it, it's going to clean up a lot of issues.
The only thing I think we need to be very careful of here, and it's more of the economic situation, but I'm seeing a lot of small businesses really, I mean, I appreciate what you're saying, Simon. I'm definitely going to be getting involved because I'll be able to have evidence that will support this. With, you know, a lot of the national wage has always been about the individual and a fair rate of pay, and that I'm not going to get into. But from a business perspective, when you do national wage, whether it be apprentice, reducing to 18, 20, when it's not just that rate, it's the differentiation between the next level up. So if you imagine in 28 you've got an 18-year-old that, and you've got a national wage paying employer because of whatever, you'll have an 18-year-old potentially leaving school, coming in to do a job with no experience, while you might have somebody else on the same rate who's been there for 10, 15 years, which is going to mean that those employment costs are going to have to go even further if, you know, because there's an unfairness then, you could argue, with the individual who's got all this experience. So that employer may have to say, I need to up their rates, which we're seeing sort of either way. So that's my concern really, is will it change behaviour of employers either to not recruit? Will it stop or change the behaviour of taking on apprentices at all? Because don't forget, when you know, whilst they're encouraging, this government now are encouraging skills within the UK, that's all well and good if the employer can actually afford to train them. So it's, I think, the economy balance, which the Low Pay Commission obviously, I hope, will take into account, because it's, you know, it's got the cost of living for individuals, but I think it's going to have, let's call it, the cost of living for businesses, if they want to achieve the overall, whatever the government's outcome is. So I'm sort of slightly different angle from a business perspective, and I'm hearing this on the ground.
From that side, Karen, the Low Pay Commission, it does look further than just the rates and the individual. What their role is, as part of looking at particularly the youth rates, is what can they do to improve those rates without becoming a detriment to the employment prospects of those age groups. So they should be taking those things into consideration, and absolutely, if you've got evidence and things of that, I'm sure they would love to hear that, because they're always looking at the macroeconomic side of it, not necessarily just those individuals. So that is very important. And I suppose, sort of as a wider point to what you've said, Karen, there are a lot of things going on now at the moment that I feel that the government are treading more carefully around increasing costs to employers. One of the things that stuck out to me recently was the potential changes to the automatic enrolment percentages, kind of quietly kicked into the long grass because they feared, probably quite rightly, after the national insurance increases, that employers would not be very receptive to that if it was increased too sharply, too rapidly.
Oh, nice of them to consider us eventually. Right, and there's a couple of questions that have come in. Let's go into to poll 2, and there's lots of dilemmas on salary sacrifice and some questions I want to ask during this poll as well. The question for this one, of course, is with the rise of national minimum wage and 15% national insurance charges, have you changed your salary sacrifice schemes? 4 options here for you. Yes, no, I haven't considered it yet, or not applicable. While waiting for those responses to come in from our wonderful audience, there's a couple of questions. One of them relates back to our previous section here on tax year end, so I want to just run through this. If you switch salary sacrifice pension to a net pay scheme, contribution deducted after tax and NI to keep employee above national living wage. Does that make sense? Is that a statement or a question?
Yeah,
I think it's the wrong way round, though.
Yes. Yeah. Does it work? I think is the first question, isn't it? Because who's doing that? I think you've got to consider a couple of factors, and one is you've actually entered a contractual arrangement with your employee. Are you arbitrarily changing it, or have you consulted, or have you got their agreement? Because just changing things willy-nilly without doing that may invalidate the whole arrangement.
Interesting. And
others will have different views.
Yeah, I was just going to pick up on something though. If I heard that right, is that this deduction would be after tax, in which case that makes it a relief at source, not a net pay. It's the wrong way round. In the fact that in pensions world, it makes no logical sense to us in payroll. The fact that we would view net as something coming off net pay, actually it's the other way around. If you call it a net scheme, it's actually coming off pre-tax.
Yeah, sure.
But this is a little bit of the thing that we've raised in the past, in that, yeah, if you used a relief at source scheme, it doesn't necessarily have the same implications as a salary sacrifice scheme in terms of taking pension deductions and the national minimum wage interactions. And it doesn't necessarily seem fair that that individual has the exact same amount going into their pension pot, but actually their take-home pay is going to be different between those two different ways, and both of them are completely fine to use. So we have raised that, we'll continue to raise that, but yeah, it's a good point.
Okay, good. I've seen the polls that's just been shared. I'll come back to those in just a moment. This is a second question that also came in. I just wanted to bring up to our panel. How do we know if our organisation needs to apply for an STBV? We have overseas visitors, may 1 or 2 day max, never exceeding 60 in any given year. HMRC guidelines seem very hazy. Thank you. I'm not sure what that acronym is, but I'm hoping one of you guys.
Advised.
Yes. Short-term business visitor.
Yeah.
Yes. Yeah.
But it's tax advice. You need to go to a tax advisor to get that interpreted. Yeah.
Okay, super. Shilpa, if you can find somebody can give you who's audited and registered to give you tax advice, hopefully they can help you with that query. Yep. Okay, well, let's jump back to the poll.
There are pages you can go to, Nick, to find them. So signposting is permitted, as it were. But I think the payroll angle is more of, you've already got that established. What do you do in payroll? We can tell you till the cows come home, what you do.
So poll results, we've got yes at 15%, no at 60%, haven't considered it at 2%. Maybe that will change. Maybe that statistic has even changed during the course of this webinar. And not applicable, 23%. Karen, let me come to you. What are your thoughts on those results?
Obviously without any context, so it may be that all those in the 60%, or I hope, mean that they're paying in excess of the national minimum wage, and therefore they haven't needed to consider it. If that isn't the case, then you need to be considering it, if that makes sense. So again, you could put the same of haven't considered it if you either don't have a salary sacrifice, or that could be non-applicable. But I say it depends on your wage bill. If most, if not all, your employees are well above what is national minimum wage, then you wouldn't need to consider it on the whole.
Sure. Well, let's jump into a hot topic at the moment, the role of AI and data analytics in payroll. I've just come back from Payroll Congress in Orlando. This was the center of about 50 different talks. Everyone's talking about analytics. Everyone's talking about how we can raise the profile of payroll to get its seat in the board table. Everyone's talking about the role analytics can play in that as well. So lots to go through. I've just put a link in the chat as well. If anyone's interested in why payroll deserves a seat at the C-suite table, there's the latest payroll podcast has come out with Maria Mason, who talks about that in some great detail. There's a link in the chat if you want to click through to find out more and listen to that episode. But hey, how do we know what it's changing? Can we make changes for the law changes? What does the future look like? And business challenges. Let me start with you, Richard. You must be getting a lot of feedback from your clients and are being asked lots of questions, I'm sure, on a lot of AI and data analytics. What's your view?
Yeah, I think, as you quite rightly say, it is becoming far more frontline conversation, especially with the world today. You know, it's very easy for a payroll provider or a payroll manager to be showing at the end of the month how much the payrolls cost and hoping it's going to get signed off by the FD. But I think the world has changed. I think, you know, employers are looking for that area and the analytics of it, a far more granular level of knowledge and information, which can be provided. But I guess also it's trend, common variation. So I think from the actual delivery side and the reporting side that AI can provide, it certainly can be a far more granular, structured and fast process to get probably more detail than you'd think you'd be able to find yourself. So I think on that aspect, it's very strong. I think the other key aspects then is what is the wider, I guess, integration that the payroll department should consider. So are we thinking of chat GP looking at answering queries, having support on your website, understanding learning, even, and then obviously for my business, AI is becoming a larger and larger percentage every month in what we do. So I think it's a couple of things. I think it's number one is not being blinkered to what people perceive AI to be, but second is I guess embracing the amount that it can give you and support you with to actually deliver better and report better within the business.
I think as Simon will know, the key thing I would advise people is you don't necessarily need to be an AI expert in order to be able to embrace AI. A lot of the software providers are doing a lot of this grunt work for you. They'll make it more efficient, and actually using AI when it's already been implemented, the idea is it gets simpler, it's relatively straightforward. But Simon, you're involved in some of these forums. What are the things we can start to expect? What are you seeing in the world of AI and software development?
Well, I think there's an element of caution that comes to mind a little bit of thinking. It's a bit like when blockchain came out, there was an element of thinking blockchain will answer the problems of the whole world. And I think it's an element of what do you think it is and what do you think it can do? If it fits, fantastic. But don't think it fits everything.
I would argue blockchain still could. I think there was a pause, but it's coming back again in force now. It's changed, right? It's evolved.
Well, it depends what for, thinks the Nick. So,
Sure.
Nick is the issue. And I guess there's an element of just because you're going on a journey doesn't mean it all has to be done on a plane. But it's kind of, if it fits, then great. And so it's seeing that benefit. But sometimes I'm seeing AI pushed for an element of something it doesn't really fit. In other words, it's going to take your job away. I don't think it is. It's there as a tool to enhance your job, isn't it? And make life easier in obtaining more detailed and accurate information. I would say I had an experience last month, Nick, because one of the articles I published got picked up by an AI engine. I had 125,000 hits, which was, you know, I'm just waiting for the check to come through because it's the first personal post I've had that seemed to go viral, and that's great. But there is an element of some of the AI experiment for me has been I've looked in to find some documents or information, and it's come back with my article, which is a sort of self-testament. But there's that element of thinking how it goes. So I think it's got a great future, but I think it's a question of what question is it answering, and I'm not sure that's necessarily always clear. But is it a means of getting good information quick? Certainly on the topics we've discussed today, potentially, I think that's where its future is it can deal with these queries.
A couple of things to think about. If you're using any of these language models, they're a lot more than just GPT. Be aware they do hallucinate. There's a great example of a case in Wyoming where two lawyers used GPT to find relevant case law in a big case against Walmart, so a huge organization. And GPT and the other language models like to give you answers that solve your problem. So if there isn't one, they may create one, and they created some case law that actually was fictional. The lawyers didn't fact check it, used it in court, and it got thrown out because it didn't actually exist. So do be mindful if you have a payroll problem, and sometimes we have questions on this panel which the panel struggle with because payroll is very nuanced and it's complex. If the language model you're using doesn't have an answer for you, it may create one and try and use its abilities to give an answer that just makes sense. Of course, that may not be the accurate response, so you do need to fact check a lot of this stuff. There was also a report that came out in Forbes earlier this week. I'm on a webinar on Fridays talking about where 7 jobs that are vanishing fast, and they put payroll and timekeeping clerks, so very much the junior level, in that list. It comes in at number 5. What I would say, and I've obviously come back from Congress doing some interesting talks over there, is every payroll person, I'm sure most of the people on this webinar, by all means comment if you're one of these, are working harder than they've ever worked, and that's with AI coming in. So if you're worried about it taking your job, there's a lot that the payroll profession are doing at the moment. It's going to be an impossibility to replace you entirely, but it can absolutely replace some of those, those manual-based tasks, and that's very much what this report from Forbes talks about, the manual elements of the role, so we can focus on different elements. I think on the analytics side, of course, that brings us closer to HR and closer to finance, and we can really become more collaborative, and I think that's important if we're going to raise the profile. But I'd love to get a view maybe from you, Matthew. You obviously get a lot of feedback coming into you from different members, and I know there's a lot of concern around AI, but also a lot of excitement. What's your take?
There's a lot to dive into. One of the things that I would just quickly say is that companies need to get ahead now of your AI policies and procedures, because, as you said, ChatGPT, etc., the generative AI is very accessible. It's very easy to use. But you also need to be aware that we're payroll professionals and we deal with a lot of sensitive information. And if you are using a free version of those softwares, anything that you put in essentially becomes part of its training data. If you pay for a version, if you pay for the premium tiers, I think to a lesser extent, because they want companies to use it and they don't want to be sort of infringing on people's personal data. But you obviously do need to be aware of the GDPR implications and any sort of sensitive company information. I think very early on in ChatGPT, someone in government put something in and essentially schematics to something became part of its training data. You absolutely don't want that to happen with the sensitive information you have in payroll. So as a company, you need to make sure that your AI policies and procedures are very clear on what you expect your employees to do and not to do with any AI that they're experimenting with.
Yeah, good point. I'll come to you, Karen, in just a moment, because you raised a point for me there, Matthew, as well. Heaven forbid you may be trying to recruit payroll people direct and not working with JGA, but if you are doing that, be very mindful that GPT and other language models enable people with almost no experience to create very wonderfully looking CVs. So you do need to be more mindful and vigilant as well. It's very easy to put in a job description and say, create me a perfect resume, and now it will come. And we're seeing this at scale. We're seeing CVs look almost identical to each other. And you do, if you're not familiar or not regularly recruiting, you need to be very vigilant. And I would recommend, if you're doing it direct, bringing back in those old school payroll assessments. It's funny how, and obviously there's an ACT platform that Richard's very familiar with, which could be a really good resource for you to do that. But it's really interesting because sometimes with advancements, things like AI, it forces us to go backwards to old school kinds of assessments because it's very hard to sometimes see the wood through the tree. So again, vigilance is key, whether you're using it for yourself or whether you're using it to assess others. It's very easy to homogenize the whole process with fancy sounding CVs that have been created by GPT. So be mindful of that. Karen, you obviously use it in a very different way as well and got a different perspective. What's your view on the future of AI and data analytics?
Well, I'll be very quick because I must leave at 3 for that HMRC meeting, I'm afraid. For me, I'm really excited by the future. I'm, like Simon, cautious about those who use it for bad things, like producing CVs for experience that they don't have. That would be, I find that very disappointing of somebody who wants to claim they're a payroll professional. Clearly, they're not if they're doing that. I don't mean not use the language model to do your own, but with the right information in it.
Yes.
I personally love Copilot. That's just my preference. I find it shaves hours off my role. And I mean, you know, writing reports, it's like, oh, here's what I want to do. The other is, you know, with all due respect, being client industry, sometimes, you know, you maybe want to send an email that would be inappropriate because you've put emotion in it. There's nothing better than having a good old rant on email and then putting it into Copilot and say, please, could you make this polite, professional, and with understanding? And it comes back out and you go, yep, that's really what I need to say. So for me, I am very much an expressive person, so it also has that functionality rather than me keep rereading my email that I know I can't send, and I have to keep redoing it until I'm at the point where, yeah, I think that's okay to send. But you could argue that that's laziness as well, but I just think I'm utilising a tool that is available to me, just like I use software, payroll software. I utilise the tools that are available, and I'm really excited to see how payroll software interacts with the robotics of the future, AI controlling those robotics of the future. Can't wait to see it, but with caution at the same time.
Sure, great. Use the word tool. I'm conscious that Simon and Karen is to jump off in just a moment. So use the word tool. As remember, it is a tool. It's there to augment and amplify what we do as payroll professionals, not replace us. We have a couple of minutes left. So just remind everybody, if you are still looking for training, there's an SD Worx Academy coming up. And on the 13th of June, they will be talking about holiday pay, understanding entitlements, accruals pay, and rolled up pay. 17th of June is UK Payroll Part 1, income tax, national insurance. 18th of June, UK Payroll Part 2, starters and leavers, student loans and statutory payments, and 27th of June, National Minimum Wage Advance. You can find all of those courses at the SD Worx Academy, sdworx.com, so do check those out. The next PQT will be on the 19th of June, so most of those courses take place before the 19th, which is why I wanted to bring them to your attention. Please do join us. You can register at sdworx.co.uk/PQT, and you will get a survey after this episode. If there's anything you want us to cover in that next series of PQT, please let us know in your feedback forms. We'll do our best to accommodate all of your requests as we do. I just want to say this final moment to say thank you, Simon. Thank you, Richard. Thank you, Matthew. Thank you, Karen. I've been your delayed host. Sorry, I was getting a little bit late today. My name's Nick, and we look forward to seeing you next PQT on the 19th of June. Thanks, everybody.
Bye.
Okay.